I would like to welcome Akif Marchant, the Director, Engagement and Capacity Building, and the Head of Africa for Convergence, to please come to the stage. And Akif is the representative in Africa for Convergence. And so as you look at the report that's been produced, this is the guy to go talk to, right? So I will hand over to you, and then you will introduce your panel. Thank you so much.
So hopefully you've had some coffee, some snacks, and also took the 15 minutes to read the entire report. Yeah, it's working, yeah, thanks. How many of you were in the master class yesterday? I see some familiar faces. This panel is blended finance and affordable housing. Some of you were not in the master class yesterday. So maybe let's get some foundations out of the way. Because you were in the master class yesterday, who can tell us the definition of blended finance? Now everyone's not going to put their hands up. Either you're shy, you didn't learn anything. What's the definition of blended finance? Financial structuring. I recognize you from yesterday. So blended finance is a financial structuring approach to pull in development funding from the official development world, Joan alluded to earlier, and or the philanthropic world on concessional terms. And the expressed intent and purpose of this impact capital is to pull in and draw in that private capital that's sitting on the sidelines, that's not invested in housing or the geographies that we all care about. So blended finance is a financial structuring approach. And it's important to get out of the way because this panel that we're going to have is going to build on blended finance in the context of affordable housing. Now you can blend by using guarantees. You can take concessional money and put that within the capital structure of a specific project or a specific fund to alter the risk-return profile for those commercially oriented investors, such as the pension funds or insurance companies. You can use technical assistance, project preparation facilities. So there's a whole suite of instruments that you can use. And if you look at the report, we expand upon that toolkit as well. So for the next, Keisha, how long do we have? 30 minutes, 35 minutes, 40 minutes? Ish, okay. So for the next 30 to 40 minutes, I'm going to invite three thought leaders in this space and three practitioners in this space to come up and talk about their perspectives around the intersection of blended finance and affordable housing. But we want to make sure that this is engaging. So we're going to leave some time for questions towards the end. So if you have any thoughts, if you have any burning questions, please note them down. And we will save some time and keep some time for that towards the end. So it's my pleasure to invite on stage Gibson Mapfidza, Chief Business Officer for Afrique. Gibson, where are you? Yeah, can you please give me a round of applause? We have Zanele Hlatshwayo, Senior Investment Officer, Blended Finance at the IFC, the International Finance Corporation. There you are. And last but by no means the least, Palesa Mkhize, CEO of the South African Multifamily Residential Rental Association. So Palesa, if I may start with you. Blended finance and affordable housing. I define blended finance. I want you to define affordable housing. Affordable housing in the context of rentals, in the context of ownership, but more importantly, as we try to get this concessional money into this space, whether it's on the rental side or the ownership side, How do you think about, or how does one think about and define affordable housing? And how can that be built into some of these covenants or agreements with this concessional money, because that's what they're doing, they're buying impact?
Yeah. Thanks, Akif, and good morning, everyone. If you start to, and this is a question we asked ourselves putting together the report, is, you know, how do you define affordable housing? And it becomes very clear, you know, if we listen to the secretary, what's the full term? Sorry.
P.S. Hinga.
The P.S. Hinga. When we listen to him define how various areas needed a certain price point, it becomes even clearer that there is no stock standard definition. Each region will have to set aside a lot of time to determine at which point do the people who are currently not housed will be able to get into some kind of formal housing. In South Africa, that's a complete range. We were speaking to the city of Cape Town, where people who are, you would think, are completely outside of affordable housing just can't access housing given the price point in Cape Town. And then you find in the inner city of Cape Town, people are in slums and are paying something really low, but if we get them out, we need to keep them at that price point too, right? So there is no real stock standard answer. We do know that some of the DFIs tend to use minimum wage to determine that a third of that as what would be affordable, and I believe CAF tends to use a calculation around, you know, what's the cheapest house you could actually build, and that's not to say that's the right number either, because as we were told this morning, we need to bring those tenders down. Whether practical or not is to be said, you know, given the cost of raw materials. Your other question is around how do you bring that into a covenant story and the legal and all other structuring. Realistically, that's probably where I started hitting my head when I started questioning why can't senior lending just do it all? And the question became, oh, just go blend it. So, you know, go speak to friends and family at DFIs. And they're like, oh, sure, let's do it. And the more we spoke about it, the more we tried to get really where affordability lies, it became very clear that we couldn't put a structure together that made everyone happy and still met everyone's returns. So the structuring is possibly the difficult part because mandates don't meet. IFC has this, that it wants, Proparco has this, that it wants, the bank has this, that it wants out of it. So I don't have a silver bullet answer, but the best way to do it is maybe in some of the things we were taught yesterday on blended finance. You know, starting off with your concessionality and then going into your commercial pieces. And perhaps maybe the real one is by blending in your developments, so to speak. So you're definitely going to have to mix your affordable and your not so affordable in order to get to a point where your IRRs make sense, your legal structuring makes sense. I don't know if I've answered your entire question.
You made an attempt.
Thank you.
Now, there is no easy answers to these questions, which is why I asked them. That's very, very helpful to understand that, you know, there is no agreed upon definition, but one can think of calculations, whether it's a percentage of rental paid out or minimum wage and others. Because I'm sure if you work with a Shelter Afrique or an IFC or an African Development Bank, in order to bring some of that money at the table, you need to have at least some definitional alignment. And both of you are nodding your heads. Gibson, if I may come to you. Shelter Afrique is the preeminent development bank on this continent for the housing space, and affordable housing by definition also should be in your mandate. We spoke about blended finance. We've spoken about the last couple of days about blended finance. What instruments does Shelter Afrique have in its toolkit that can be used to blend with this private capital? So we've spoken about guarantees and viability gap funding and subordination within the capital structure, but tell us what kind of instruments do you have, and how does one work with Shelter Afrique to make sure that they have access to that?
Okay, thank you so much, Akif, and good morning, everyone. So, from Shelter Afrique Development Bank, I think we initiated this about 2 years ago. And I think our departure point or our motivation was really to try and make our financing affordable. So what we have done is we have created a unit, we call it Fund Management Group. Under Fund Management Group, we have identified key thematic areas like green is one of them, gender, SME, immigrants, diaspora. So what we then do under it is to create design products that enables us to engage with providers of this thematic fund like GCF, Green Climate Fund, for example, under Green, Islamic Development Bank as well. So we attract concessional funding, which concessional funding we then use to stack up with our core sources of capital, equity and debt. And what it allows us to do is to then optimize our cost of funding, like Palesa explained, in terms of ensuring that our cost of funding, our work is talking to the return of the project. So under there, in terms of specific products we are using, I think I can say concessional capital that we also deploy towards our project. Most importantly is when you engage, especially with the government, our National Housing Corporation, in most cases, what they say, we have a project, they just have land. I have really gone around Africa, you meet with them, all they have is land. And yet an investor is looking at a financial model. So we also provide PPF. And the idea is to de-risk and to enable our developers, private sector, but also the public sector to move from land to a financial model. So what do? We provide technical assistance. We also provide project preparatory facilities. And the idea is to enable them to do the land surveys, to enable them to do town planning, and also the design of the infrastructure, model houses, and cost all these so that we are able to estimate the total development cost and also estimate the inflows. This, in a way, helps to engage with financiers, and we have, in a way, de-risked or gone to diagnose all the likely issues that will cause the risks, and with certainty estimate the cost as well. What we have also been doing, so that's talking more on the supply side, we have also engaged with partners, and I'm very happy that ZEPRI is here and Peter is here, to develop guarantees. And guarantees, we do them both on the supply side, but most importantly on the demand side, because we very much look at housing as a value chain. So we have done guarantees like the collateral replacement indemnity, and the whole idea of collateral replacement indemnity, you know that across Africa, for you to get a mortgage, the loan-to-value ratio is around 70% on average, meaning that the prospective buyer has to raise 30% of a deposit. But what collateral replacement indemnity does through our partners, they give insurance for that 30%, meaning that the loan-to-value ratio becomes 100. What we have seen it doing, it allows people who were not eligible or were not able to raise 30% now to be included in the mortgage bracket. So that have also assisted us in terms of ensuring that on the demand side we include more people in the mortgage bracket as well. The last guarantee that we are also working on at the moment is the first loss default guarantee. And essentially what we are trying to do is to mitigate the lender's risk by getting the first loss guarantee. And we are working with two insurance companies, guarantee companies, to ensure that when we give lines of credit to our banks across Africa, across our 44 member countries, they are also able to advance these facilities to the SMEs, knowing that they have a risk mitigation way in terms of if there are any losses, then the first loss default guarantee kicks in. So I think these are the 4 instruments that we are currently using. But for us, the fund management group is really meant to attract concessional funding, which we then use to blend to optimize our cost of capital, cost of funding to the project. Thank you.
mean, if you ask most investors, whether they're pension funds or insurance companies, they'll all say, yeah, housing sounds interesting, but the returns are not commensurate with the given level of risk that you're asking me to take on. And essentially what you're doing is you are mitigating or shifting some of those risks with the various instruments in the toolkit that you have on tap. Yeah. And for those of you who are wondering, you know, how organizations like Shelter Afrique get funded, you've got, of course, paid-in capital from the various shareholders, the various governments, and then you borrow on the markets as well, on the backs of the shareholders that you have. And at the same time, as you mentioned, you're partnering with these development partners to bring in some of that money to blend with your own account to get money out of the door. And another interesting example of that is the IFC's MAGIC program, which is, I believe, supported by the UK FCDO. So maybe you can tell us, Zanele, about the IFC MAGIC program. What is it? What is it meant to do? And how does it actually unlock IFC's own capital, which is often deployed on commercial terms, into transactions that you wouldn't be able to support otherwise?
Sure. Good morning, everyone. It's a true pleasure to be here. Thank you for the invite. Maybe just out the gate as well, just to share a little bit of our investment thesis as the blended finance team, which is the team I sit in within IFC. And I think a common pitfall often when we talk about blended finance is that it sort of is that silver bullet, right? It's supposed to fix all the challenges in the world immediately. But certainly our thesis from my perspective is that, you know, blended finance and concessionality has to be used strategically, right? So for the most part, we try at all costs to view it as sort of a standalone subsidy. It's important for us to make sure that whatever blended finance we're directing towards projects is catalytic in its nature. And so we're very proud of MAGIC, Keith, to your question around what is it. So it is indeed a partnership between the UK government and IFC. It's a blended finance vehicle, and really what it's meant to do is help ignite investor confidence in the housing sector. So just to sort of maybe make it more tangible for people in the room, what we did in that particular transaction is that we were approached as IFC to invest in the IHS Green Fund, Housing Fund. And, you know, at first glance, difficult market, fairly nascent sector, not necessarily something that satisfied sort of our investment appetite. What MAGIC did, which was really innovative at the time, and our hope is that we can replicate it, is that it allowed us to come in with a blended finance tranche. So IFC co-invested with MAGIC into the IHS fund. But what was really unique about the structure is that we didn't invest directly in the fund. We invested in essentially a sidecar approach. So it was a special SPV. And what that then allowed us to do is MAGIC essentially took a first loss position. So it allowed IFC some downside protection, which enabled IFC to then participate in the transaction fully on commercial terms. And I think what that did as well, I think in effect, is that it also signaled to investors that, hey guys, actually this is a credible investment. You know, IFC and many others are writing sizable checks, and it can be done on commercial terms. And so I think that is a really powerful example of how blended finance can be used to offer some sort of, you know, that sort of downside protection, particularly for equity investments, but without necessarily sort of having to take very big cuts on your returns, as you had mentioned. And if I may, maybe I can share what the key lessons for us were on that transaction, because I think it could be of interest to people in the room. I think the first is that it was an absolute validation that actually blended finance can be used in this sector. It can be used widely and can be leveraged to really sort of catalyze investments in the sector. So in many ways, it was a proof of concept for us. But I think it was also a very important reminder, Akif, that concessionality in and of itself has to be, as I said, catalytic. It can't be market distorting. It can't be used in every transaction. And so that's why we're very careful in our team to make sure that the blended finance solutions that we do bring to the table, for the most part, are once off. right? They really are catalytic in their nature, but it's not an expectation that whatever models we're trying to push will be reliant on blended finance going forward. Because ultimately our view is that blended finance should be pioneering in its nature and not necessarily leverage for every transaction needed. So that's the first, just the power of using concessionality, but using it when it is appropriate. The second one is the importance of strong sponsors, and I do believe we had that in the IHS transaction. So we had knowledgeable sponsors who had deep networks, who understood sort of the local nuances, and that was really important. And I think if we are trying to replicate this model in South Africa, in Namibia, in Nigeria, in Cote d'Ivoire, I think it really is important to some extent to commit to a level of indigenization. And I think this transaction was testament to that. We found very strong local partners and we were able to get the investment over the line. And then the final learning, I think, here is the importance of replication. And I don't think there's anyone in the room who'd disagree with me that replication is important. But I would challenge us to take it a level further. So what does it mean to replicate an investment in Kenya, and then in Namibia, and then in Mozambique, and then in Egypt? And I would argue that the through line here is on three fronts. I think the first is, as I said, the local partners. So that is sort of a given. I think the second, and I speak as an investment officer, right? I think we all agree that the importance of having a robust, bankable, high quality, visible pipeline is important. So it's one thing to talk about replication, it's one thing to say that the housing sector needs support, but if you don't have quality pipelines or underlying transactions that are bankable, then it's a non-starter. So I would say the through line there is that, you know, these transactions and these pipelines have to be absolutely bankable. And then the last one is kind of speaking to the point I made earlier just about the scalability of fund structures. So the ability to replicate IHS, as I said, in Nigeria, in Cote d'Ivoire, you really do need to have those scalable fund structures, and that's certainly from an IFC perspective, that would be incredibly encouraging for us, and we would very quickly support those kind of structures across the continent.
There's a lot in there to unpack. But I think what should also be underscored here is that this would not have happened if it wasn't for the government of the UK and FCDO supporting this. And I believe, if I'm not mistaken, there is a green flavor to the MAGIC program. The G stands for green, right? Green
yes, so it's supporting green construction.
And the reason I mention that is if we are going to, like when I go to talk to the Swedish Development Agency or the British Development Agency or JICA, I know we have some Japanese friends here, or Koreans and KOICA and others, you don't really usually see a affordable housing team or a housing team even. But you have a climate team, you have a gender team, you have a health team, you have a financial inclusion team. And so the FCDO was approaching this from a green perspective. And I think we've spoken about that earlier, is how do you frame housing in a way that also aligns with some of the other SDGs? And in Gibson, you have development partners from France and from other countries, but you are the Shelter Afrique Development Bank. So how do you at Shelter Afrique, how do you tell the story of housing and align that with some of the other SDGs to bring some of that money in that leaves the door under the ambit of gender or climate and others? How do you sort of bring that together?
That's a very good question. And, I like the breakfast session. And John, you said housing is a near investable. And for me, I think that was very key. So I think the truth, like you're also saying about IFC, they may not have a dedicated housing unit. I know they do. But so the truth of the matter is housing gives a very good value proposition. You talk of inclusivity, building wealth, climate change, the two, because you see the built environment contribute about 40% of greenhouse gas emissions. So the value proposition is very good. Truth of the matter is the risk and the retained relationship of housing, especially when you look at the bottom of the pyramid, is not very much good. And how we frame the discussion is really to go beyond and demonstrate that both the DFIs and also institutional investors, the pension funds, they can indeed invest in housing and do well in terms of profitability, but also do good in terms of impact and also climate change. What is very key, I think, going forward, which I think at the moment is lacking, is we need numbers to demonstrate that story. And I think there's a gap. I had a conversation with Kesia in terms of we need to profile projects and demonstrate that story. In as much as the value proposition, the natural one is very much compelling, but I think we need numbers going forward to profile it and ensure that investors are assured that they can invest and also be able to do well. And I think the Kenyan model for us is very compelling, which is, you see, separating the horizontal infrastructure plus land and also the vertical infrastructure. Because what is currently happening in most African cities or countries is developers are left alone to do off-site infrastructure, the horizontal infrastructure. And they load that cost on the total cost of housing. And it leads to the eventual cost of housing going beyond the affordability threshold. But traditionally, you need to then charge the house in terms of the vertical, which is the on-site development. So I think the story has to really be branded, the Kenyan story, and look at how they've managed to do it. But us as South Africa as well, what we have managed to do is to create a vehicle, because the obligation to carry the offsite infrastructure is normally placed on the municipalities. But I think because of capacity, they are not able to do it. So we need to create a PPP, which we have started doing, which take away the offsite infrastructure and create a structure that enables to bring in investors and repay, so that the affordable housing charge you are passing on is really for the vertical infrastructure. Thank you.
Just some insight from some of the interviews we conducted during putting together the report. We interviewed a gentleman from one of the development finance institutions, DFIs, and he said he thinks where the real issue is that housing still sits under real estate or is thought of as real estate finance. And what that leads to is that you start looking at it like you would industrial or commercial or retail, which is something that you kind of wake up in the morning, you decide, oh, there's a piece of land, it's good for a shopping center, get approvals, build it, next thing, this thing is generating some kind of income. And housing isn't that. If anything, he said, we should be looking at housing like you do a toll road. You should be looking at housing like you do a renewable energy project. These are long lead times. Why? Because when you build housing, your regulatory runway is not as when you build a shopping center. Conversion of that land, all the regulatory and planning pieces that come into play, it's years before something actually works. And sure, yesterday we argued that maybe the sponsor must just get that done and only start speaking to money the minute all of that is done. But it becomes problematic to the points that you're making. So it might be, something that the people with the money need to think about. Do we not reclassify housing as infrastructure? Because then you can play a role right from the beginning, and you can find the right tools, and you can adjust your mandate accordingly so that you take into account how long it takes to get a housing project from raw piece of land to top structure.
The previous, Joan, your session was titled Making the Numbers Work. And it is about making the numbers work because that's the heart of financial structuring. But it's also a storytelling and framing issue, which is something that's coming out of the last couple of days. And this challenge around demonstration effect. And how do we actually tell people the stories that have actually worked to show that there is a gap between the perception of risk and the reality of risk, and the more data, information, examples, case studies that we put out there, the better. So if you do read the report, you'll see 4 case studies. That is us playing a part in terms of putting these stories out there. One last question before we open it up to the audience. Palesa, if I may come back to you. When we talk to institutional money tells us we want large ticket sizes, we want diversification across currencies and across geographies to some degree, we want investment grade product, we want product, don't over engineer and over financial, don't go overboard with your financial structuring. I want something that's easy for me to understand, because every time you bring a bespoke transaction with different bells and whistles, it makes it more complicated to get it passed through IC and so on. How do we, so we've got the demand, supply side of capital, this large institutional money from PIC and here in CapFIC and others. You've got a decent pipeline of projects. How do we intermediate from a product perspective so that we put investable transactions in front of these insurance companies and pension funds? Maybe you can sort of talk about that and talk about some of the examples from a SAMRRA perspective, because you did some of that there.
I think the role of the intermediary is massive. We have the guys from TAF here, and we did a case study there as well, and they do a big intermediary role where they're able to raise from institutional investors and then take that into your emerging developers. And I think where it becomes critical is creating intermediaries who understand the game. We were lamenting earlier how the sector just lacks individuals with the right skill set for doing some of that work. And a large part of that work is about having people with really significant levels of finance and understanding finance. A lot of us understand housing, you know, town planners, quantity surveyors. You know, we've got very good backgrounds in putting brick and mortar and making it happen. But the sector, as with renewables, toll roads, you know, the works, they all have quite a large contingent of people who understand the finance. I mean, I spoke about TAF. I mean, they have a securitization structure in there. And if you speak to the room about securitization structures, they're going to look at you funny and they're going to say, what's that? But that was able to catalyze, I mean, lending from Standard Bank and other sources of mezzanine. And I mean, that's just a very long journey. And it's not what they were able to do on day zero, by the way. It was a lot of, you know, as we said yesterday, track record building. We spoke about the CRRH in West Africa. Again, another case of a great intermediary finding access to large pools of money. And why? They had a great track record. And not only were they able to access capital markets, they were able to list the first social bond in the country, 15-year tenor, 6%, which is really unheard of in that region. And again, they had been doing it for about 7 years or so before that, and this was their 10th bond. And they're a great intermediary because they know what they're doing. They've been doing it for a while, and they've got some really good finance skills that sit within their organization. So in order to ultimately get to a point where we are attracting large pools of capital, as with the IHS deal, again, another case study in the report, for the most part, I'd like to say that they're also an intermediary, you know, as in, you know, funneling money from the one end to the other. Track record, great skill set in your entity, and understanding the housing market as a whole. We visited the units yesterday, and I think for those who were on our bus, we were all just absolutely floored at the quality, and to understand that you can achieve that at that price point was absolutely phenomenal. So there's a real good story to tell around how good intermediaries can create large pools of you know, sources of capital to execute in this market.
And intermediaries do matter, and we at Convergence have a grant program. So we've provided Althelia Capital, that's somewhere in the room, with a grant to design a transaction so that they can draw on and pull in capital into the housing sector in Nigeria that would not otherwise be invested in that specific sector in Nigeria. I'm going to open it up to the audience. Anybody with burning questions? Notice I say questions, not comments. Or any questions? Questions from the audience. Do we have a mic? Can we get this gentleman up front a mic, please? So we'll take about 2 or 3 questions. Maybe we'll take one question at a time, perhaps, because sometimes you forget the questions. So maybe you want to identify yourself. So your name, your organization, and a brief question, and a brief answer as well.
Sorry, my name is Moriga. I am with Wood Green in Toronto. and I attended the masterclass. But the one thing I got out of it is a blended finance requires a blended product, and a blended product also required some kind of a blended capacity. So my question to the three of you, because sometimes we tend to lean on the capital market side, and this one's directed at Zanele. What are some of those, like we are dealing with affordable housing, what is it that we need to do in order to be a better bankable agency that also has, at the end of the day, affordable housing? And I also wanted to, for Palesa yesterday, I think you referred to the construction management side or the construction side of what makes a bankable organization in terms of the product. So just making a better specific link around the affordable housing outcomes that we're trying to achieve.
So can I just clarify the question? So, and if you can...
What do you need to do as an organization to be bankable? So,
From a perspective of a developer, or?
Especially because the focus is it's easy to do market housing or
Yeah. So, I mean, look, I think it's a good question. I think, and I'm not sure if you'll be satisfied with my answer, but I can tell you certainly from an IFC perspective, when we are now looking at partners and doing our assessments, I mean, obviously we look at the robustness of the partner themselves, their track record, their understanding of the local context, who they partner with themselves within the local market. I mean, those are important to us. But I would say the really, absolutely the deal breaker for us is just the quality of pipeline that is being presented. And I think it touches on a lot of the themes that were mentioned here as well. I fundamentally believe housing is infrastructure. So it's not just about your ability to show us, a lovely deck about, a 28-floor development. I think it's your ability to assure us that the entirety of the transaction can come together based on your experience, based on your understanding of the local market, and also just based on the quality of the projects themselves. And so, we would look at the robustness of your pipeline, but also would look at how long-term the project is. I can tell you certainly from an IFC perspective, and this isn't sort of necessarily direct investments, right? So how we work with as IFC is that we can come in at sort of the instrument level. So if we have appropriate instruments that resonate with you and are fit for purpose for your project, then of course we can look at that. So whether it's sort of an FX guarantee or whatever, we can look at it at an instrument level. But what we're also looking at is the ability for us to participate or support your company through the capital markets, as you mentioned, but also on the regulatory side as well. So even though our promise isn't necessarily that we'll come to you and partner with you because it's appropriate, I think there are various avenues in which we could lend support. So I know, sorry, that doesn't answer your question. It's very specific on partners, and I'd be very happy to have a conversation with you. But generally, we're looking at robustness of your pipeline, the context in which you're operating, but also how well networked you are generally in the local landscape.
Any other questions? One more question from that gentleman who's got his hand up.
Yeah, my name is Sadiq Nyanzoa from the Central Bank of Tanzania. Yeah, one of the area on which handling the product for affordable housing is interest rates, the cost of funding. I've heard about submission of the gentlemen and the ladies there influent. None of them touched the issue of interest rate, which is very important. And we know that one of the factors that drives the interest rates to be high is informalities. And we've heard here about 75% of, let's say, Kenya, there are people who are living with low cost or people who are poor in terms of affordability to have housing here. So what I'm trying to see here or to hear from the panel that, for instance, we've heard from South Africa about the guarantee incentive. how does the guarantee incentives help to reduce interest rates? Because we are talking about the poor people here. One of the factors that hindering them to progress is interest rate. Interest rate is high. So what sort of incentive can you believe that may scale down the cost of housing so that what we are talking here about people having affordable houses is going to be easy and objective can be met easily? Thank
This
you.
is a very important question, and this has come up in the last couple of days as well in terms of actually driving down the interest rate itself versus the perception reality of risk. Any of you want to talk about how do we actually really push down that cost of capital and reduce the rates?
Yeah, thank you. I can go first. So I think when you look at the whole concept of blended finance, the idea is to try and de-risk or reduce the risk of the project. And I think the thrust is to reduce risk both on the supply side, in terms of land, in terms of the technical assistance, to improve the capacity of the developer, and also on the demand side, we spoke of collateral replacement indemnity, the first loss default guarantee. The whole idea is to reduce the risk of the project. And I think the other question as well was around the market, the off-take guarantee. When we develop these houses, do we have people, and in certain cases we say, can you pre-sell 30% of the houses? So once we have achieved reducing risk, it means the cost of funding, which is interest as well, we are able to attract cheaper funding, if I may call it that way. And the concessional funding also help in terms of the capital stake. So the whole idea is to reduce the risk. Like Akif said, the perceived risk versus returns of especially affordable houses in most cases is not matching. So the idea is to reduce the risk. So part of what we do is to partner with our prospective customers, developers, banks, offer advisory service. In most cases, what we're trying to do is to frame the project, structure it from a financier perspective in terms of managing all those various risks across the value chain. Once we do that, we are also able to then reduce the cost of financing, which is the interest rate.
Palesa, as our star author of the report, I'll give you the last word on interest rates, and then we have to call time.
Sure. I don't think I have anything profound to say, except to say that, the role of the intermediaries, because we know that the sovereign is really why we face the interest rates that we face. And that is underpinned by all sorts of other economic issues. And where we've seen success is where intermediaries have been able to raise from DFIs outside their country, and that money has come with levels of concessionality that either lock in that interest rate. I go back to that CRH example. Their issuance was underpinned by 12% from Propalco. I know I spoke about all of this yesterday, but there are key credit enhancing things that ultimately allow you to create a pool of cash that is protected from any kind of volatility. So the trick more than anything is to find sources of cash that will lock you in and not allow your national issues to play a role, or your sovereign issues to run amok on what it is you're trying to achieve as a housing sector, and then ultimately, healthy intermediaries that can have that track record to attract that kind of money.
So the idea for this panel was to really pique your interest in the report that we've published. And the report we published is for all of you. So please, if I may encourage you to read the report, share it with your colleagues, share it with like-minded folks in the sector. That would be really, really appreciated. I think all that remains to be said is to thank all of you, the three of you, Palesa, Gibson, and Zanele, for your time. I really appreciate you making the time. Thank you for being an attentive audience, and thank you, Keisha, for having us. Appreciate it.